Something huge is happening with India's tax system. We're talking about a massive overhaul, a fundamental restructuring announced by Finance Minister Nirmala Sitharaman. This is GST 2.0. And believe me, this isn't just some minor adjustment, it's a complete reset of the board. So let's get right into it.
So what does this all mean for you at the end of the day? What you really want to know is, will this leave more money in your pocket? Is that big screen TV you've been eyeing finally going to get cheaper? Well, the short answer is very likely yes, but there are some really important details we need to unpack. We're going to break down exactly what these changes mean for your wallet, for businesses, and for the entire Indian economy.
All right, so here's our game plan for this explainer. First, we'll cover what's actually changing. Then we'll dig into the why this was so necessary. After that, the part you've been waiting for, the impact on your wallet. We'll also see how businesses need to adapt, look at some of the challenges, and finally, peek into the future of GST.
Okay, let's kick things off with Section 1 and get to the heart of it. What is changing? And it all boils down to the new rate structure, which is really the engine of this entire reform. The biggest change, the main theme here, is simplicity. The old system was, well, it was a bit of a mess. A complex web of 4 different tax rates, 5, 12, 18, and 28%. It caused a lot of confusion and a lot of headaches. GST 2.0 just gets rid of the 12% and 28% slabs, creating a much cleaner, straightforward, 2-rate system. This is a huge leap towards that one nation, one tax vision we've heard so much about.
So, that first bracket is the new 5% merit rate. Think of this as the rate for your essentials. This is what keeps your daily use food items like ghee and butter affordable, as many of them are actually dropping down from higher tax slabs. And, very importantly, it also now covers man-made fiber, which is a real shot in the arm for our textile industry.
And then we have the 18% standard rate, which is now the default for most goods and services. Now this is where you, the consumer, are really going to feel the difference. Big-ticket items like TVs, air conditioners, and dishwashers, things that were previously taxed at a whopping 28%, they're all coming down to 18%. That's a straight 10% tax cut, making them a whole lot cheaper.
Finally, there's a new 40% rate. Now this replaces that old 28% slab, and it's specifically targeting what they're calling sin and luxury goods. It's a clever two-pronged approach, really. One, it's designed to discourage the use of products like tobacco and sugary drinks. And two, it makes sure that super luxury items, we're talking high-end cars, private yachts, are taxed at a much higher rate.
Okay, so we've covered the what. The big question now is, why? Why go through all this trouble? Why was this massive overhaul even necessary? Let's dive into the thinking behind it and the problems with the old system that GST 2.0 is meant to fix.
So why the change? You know, the old system was just too complex, too confusing. This reform is all about simplifying things, making it easier for everyone to comply, and hopefully reducing the tax burden on you and me. The big picture goal? To fire up consumer spending, drive economic growth, and fix some really critical flaws that were baked into the old structure. One of the biggest flaws was this thing called the inverted duty structure. It sounds complicated, but it's simple. Imagine you're a textile maker. You might pay an 18% tax on your raw materials, but you can only collect a 5% tax on the finished shirt. See the problem? Your money, your working capital, gets trapped in tax credits you can't use. By lining up the rates, GST 2.0 finally fixes this long-standing headache for industries like textiles and fertilizers.
All right, Section 3. This is the big one. Let's get down to brass tacks and talk about what this actually means for your wallet. How is this going to affect your monthly household budget?
Let's make this real. Think about buying a large television. The tax rate is dropping from a hefty 28% all the way down to 18%. So, on a 50,000 rupee TV, that's a direct saving of about 5,000 rupees right back in your pocket. That is a significant price cut, and it's designed to boost demand for a whole range of electronics. And the list of things getting cheaper is pretty long. But the biggest headline of all? GST on life and health insurance is dropping from 18% all the way to 0. That is huge. Basic foods like milk and paneer are also now 0 rated. A lot of packaged foods are down to 5%, and as we just saw, electronics are getting a major price cut.
Now, of course, it's not all price drops, and frankly, that's on purpose. Some things are going to get more expensive.
We're talking about tobacco products, sugary aerated drinks, and those super luxury goods like high-end cars. They will now attract that new 40% tax, which is a very clear policy move to discourage these so-called demerit goods.
Okay, so we've talked about us, the consumers. But what about the other side of the counter? Businesses, from the smallest Kirana store to the largest corporation, are in for a massive shift as well. So how do they navigate this new reality?
For businesses, this transition isn't just a flick of a switch, it's a whole process. First, they have to reclassify every single product they sell using its HSN code, that's basically the unique ID for every product, to fit into the new tax slabs. Then, all their accounting and invoicing software has to be updated. They've also got to figure out what to do with their old inventory, retrain their staff, and get used to the updated GST portal. The goal is simplicity, for sure, but getting there will take some careful planning.
Now, any change this big is going to have some bumps in the road. It just is. So for a fair and balanced picture, we have to look at the other side of the coin. The potential challenges, the financial implications, and, the fine print.
Okay, here's a number that will definitely make you sit up. 48,000 crore rupees. That's the estimated annual revenue loss for the government because of this reform. Now, while that new 40% sin tax will help plug some of that gap, managing this kind of shortfall is going to be a very delicate balancing act.
And here's a really interesting twist, especially when it comes to insurance. While your premiums are now tax-free, the insurance companies themselves can no longer claim back the GST they pay on their own business costs. That's the input tax credit. This actually increases their operational costs, so the result, they may not pass the full 18% saving on to you. In fact, some analysts are even predicting a small price rise to make up for their own increased costs. It's a tricky one.
Look, GST 2.0 is a massive milestone, there's no doubt about it. But the journey of tax reform in India is far from over. So what lies ahead? What's next on the agenda for perfecting our country's indirect tax system?
The road ahead is still pretty long. The big elephants in the room, things like petroleum products, real estate, and alcohol, are still outside the GST net. Bringing them in is a huge goal. Other key priorities are setting up tribunals to solve tax disputes faster and making the technology behind the GST network even stronger. And maybe, just maybe, in the long term, the ultimate prize could be a single nationwide GST rate for everything.
So how is this all going to play out? Well, it was announced at the 56th GST Council meeting, and the new rates will officially kick in on September 22nd, 2025. Now, that timing is very strategic. It's right before the festive season, which is meant to maximize the impact on consumer spending. Beyond that, the journey towards a truly unified market just continues.
So let's just boil it all down, side by side, to see the big picture. We are moving from 4 main slabs to just 2. The highest rate is now a very targeted 40% on sin and luxury goods. Tax on insurance is gone, 0%. The system's complexity goes from high to low. And most importantly, the whole focus is shifting away from just collecting revenue to promoting simplicity and boosting consumption. That right there is the core philosophy of GST 2.0.
So there you have it. GST 2.0 is a monumental step towards a simpler, more citizen-friendly tax system, and it's designed to kickstart consumption-led growth in the economy. But the big question remains, is this new two-rate structure the final destination? Or is it just one more important stop on the long journey towards a single tax rate for the entire nation?